Good afternoon and welcome to a nickel webinar. Thanks for joining us on a Friday afternoon UK time, Friday morning in North America. I'd like to thank my co-host and partner, Peter Gaston from miningnetwork.co.uk. My name is Simon Catt from Arlington Group Asset Management. Our offices are on Piccadilly in London, in case you don't know. But more importantly, I'd like to welcome our panelists who are going to educate us upon nickel. And if you're an investor or interested in investing in nickel, we will have time for Q&A at the end of this, so you can ask the experts yourself. So first off, I'd like to introduce Olivier Masson. He's the principal analyst at Fast Markets. Olivier has worked at most of the world's commodity expert forecasters like Wood Mackenzie, CRU, S&P, Roscoe. We're going to, in a minute, invite Olivier to talk us through his initial thoughts. Also joining us today, we have Steve Schofstall. Steve runs the only US-listed nickel ETF. Ticker is NIKL, which is an important ETF if you want to buy a broad-based exposure to nickel. Matt Fernley is head of research at the Volta Fund, the Energy Transition Fund, and has broad experience across the buy and the sell side, and even writes about battery metals monthly. Mark Selby has done most things in the nickel universe, including work for the most important nickel company, Inco, and today he runs Canada Nickel. With that, I'd like to invite Olivier to tell us his thoughts initially on nickel. Thank you, Olivier.
Thank you very much. So I'll just quickly share my screen here. So hello, everyone. My name is Olivier Masson. I'm a principal analyst at Fast Markets in the battery raw materials team. I look at the nickel market from a fundamentals perspective, and I produce long-term forecasts. So I am going to take you through a very quick snapshot of what's going on in the nickel market and give you a very a short-term forecast. So really, in terms of demand, there's two main drivers of demand, batteries and stainless steel. So if we look at the stainless steel side, where we mostly expect the growth in supply will be China. It already accounts for more than half of global stainless steel production. That is only going to continue. In fact, that China's share is only going to rise. In the next 5 years, we expect crude stainless steel production to grow at a CAGR of 3.2%. And the fact that it is going to be mostly in China is important because scrap availability, stainless steel scrap availability in China is relatively low. And that means that the domestic stainless steel industry is heavily reliant on primary nickel units. The same is true also in Indonesia. The two stainless mills there are tightly integrated with NPI production, but currently in Indonesia, stainless steel production is capacity constrained. And elsewhere in other countries, well, there's very little growth forecast there. And also the stainless steel industry is heavily reliant on scrap as opposed to primary. So even if there was growth in nickel-containing stainless steel production there, the overall effect on primary nickel demand would be relatively low. Another important factor to bear in mind is that it is mostly 300 series stainless steel where we expect to see the growth in the years ahead. And so again, that's the nickel containing or the high nickel containing stainless steel. So you will get so not only are you going to see production growing in China, which is reliant on primary feed, but you're going to see the growth mainly in 300 series, which is where most the high nickel content stainless steels. And so the other main driver of demand is the battery industry. So over the next 5 years, we expect sales of battery electric vehicles to double. And this is a trend that is really being pushed by governments rather than consumer preference. And basically, what that means in a nutshell is that we're beginning to phase out fossil fuels in land transport or in the automotive sector anyway, and replace it with metals. Most of the growth is going to be for pure EVs, but we also expect to see some growth in plug-in hybrids, which are likely to be mostly a transitional vehicle on the way to widespread adoption of EVs. So what does that mean for demand? Well, it means that in the next 5 years, we expect primary nickel demand to grow at a CAGR of 6.1%. Most of the growth will be in stainless steel and in batteries as well. And really by 2028, we expect the primary nickel market to be about a third larger than it was in 2023. So that's fairly strong growth because we now got two major drivers of demand for primary nickel, whereas in the past decade or two, it was really only just the one, which was the Chinese stainless steel industry. So if we look quickly at supply, mine supply for nickel is already dominated by Indonesia. That's really going to continue. And the sharp fall in the nickel price last year has led to production cuts, announcements, not in Indonesia. So really over the next 5 years, Indonesia's share of mine supply is only going to increase. This ore is being used to produce either refined nickel, but also nickel intermediates such as MHP and matte, and also now some class 1 material in Indonesia. So in terms of where the primary supply is going to be, again, it's mostly China and mostly Indonesia. So Indonesia can't export the nickel ores, but we're still expecting growth in Chinese refined production. And that is because some of the intermediates that are going to be produced in Indonesia will be exported to China for refining there. So what does that mean really for the market? Well, the production cuts that were announced early this year means that the market is already taking a big step towards rebalancing. There was a significant surplus in 2023. We expect that to be much smaller this year, so still a surplus, but smaller than in 2023. And by next year, we really expect to see the market being broadly balanced and some deficits, opening after that. So that's the last slide, very quickly. The US Inflation Reduction Act, a very important piece of legislation. But in terms of refined supply, the share of refined supply that is IRA compliant is actually very low, about 12.5% last year, and that's falling. You would have expected that to rise, but actually that is expected to drop and stay low. That's mainly because the announced temporary closure of Nickel West in Australia, which was IRA compliant material, and there really isn't that much IRA compliant new capacity coming online anytime soon. So yeah, the share of IRA compliant refined material is very low. So that ends really my quick overview of the nickel market. So thank you very much for your attention.
Thanks very much, Olivier. I'd now like to invite Mark Selby to tell us his thoughts on the nickel industry.
Yeah, no, so thanks for the opportunity to participate. It's a good group of people, and Olivier, you brought a tear to my eye with that IRA compliant graph, because I think that is the real supply demand thing people need to focus on over the next 5 years. First off, just with the news flow that we saw earlier this year, so some of you who've maybe been only in the nickel investing world for a few years, maybe have been unsettled. I just want to set things in a historical context in terms of where we are. In terms of nickel prices today on commodity producer terms, which is, again, as a person who's going to produce in Canada or someone who's going to produce in Australia, this is the nickel price that matters. And, the reality is, despite all the headlines, nickel prices in Canadian dollar terms are nearly double where we were on the previous low. And in terms of, historical context, other than the past few years, where we saw a squeeze higher caused by a big short, that had to get covered, and then the big squeeze back in the mid 2000s, we are trading at close to all-time highs in terms of commodity currency nickel prices. So for projects like ours with Canada Nickel and Timmins, we are very profitable at today's nickel prices. In terms of exchange stocks, again, there was a lot of talk about massive surpluses. Then the news came out at the end of February that China was, effectively kind of hiding about 150,000 tons or 5% of global demand. And then you've seen people, dial back their surpluses during that time period. At the end of the day, you don't sit on a lot of nickel off warrant. You'll sit on some quantities of it, but ultimately, that material will make its way to market in one way, shape, or form. And again, despite these talk of several 100,000 ton surpluses, we've really only seen an increase of about 80,000 tons, and we're sitting at about 2 weeks of inventory. If you go back to the middle part of this decade, when we did have some real significant surpluses and some real inventories build up, nickel demand's almost doubled since that time frame. So in terms of weeks of inventory, we had multiple months of inventory on hand as opposed to multiple weeks. So again, ignore the headlines. The market is not nearly as bad as the kind of headline flow that you've seen. In terms of demand, really want to emphasize, and this is a point that I think analysts don't always get right, is nickel's always been a high growth metal. If you go back since 2010, we've grown at over 6% a year. And you go back to 2000, that's over 5% a year. Since 2020, we've grown at nearly 10%. There is no street analyst who had nickel demand growing up anywhere close to that. And most of them don't have that kind of demand forecast going forward, underpinned by strong growth in stainless steel and again, all the new demand that's coming from the electric vehicle market. We see by 2030 nickel demand anywhere between 5 and 6%. We think we'll see 9 to 10% nickel demand growth carry through to the end of the decade. Last year, we went through a massive destocking in the battery sector. This is a place where, again, some of the analysts have missed. When you build capacity for the first time, there's nickel that gets utilized in the plant, but to be able to utilize that nickel in the plant, you have to build up inventory in front of the plant, and you have to build up, product for sales. And so, in the first year of new capacity, you're usually, the actual consumption is about 125% of what gets consumed in the plant. We saw this in the 2000s when China was building out their stainless capacity, and we think the same thing is happening here in terms of why people are overstating surpluses. Indonesia controls more of the market today than OPEC. They will manage the market. It's very, very important to their economy, and we expect that to continue. As well, the last while we've seen a huge amount of airtime on Class 1 versus Class 2. Fundamentally wrong. It was just a temporary shortage of processing capacity to be able to take laterite ore and turn it into whatever product the market needs. That material is now here. And again, with Olivier's chart there in terms of IRA compliant nickel, that's the real story going forward, is in terms of non-Chinese, non-Indonesian safe nickel versus Indonesia that's coming from China and Indonesia. Indonesia does not have unlimited ore. We've seen a big drop in ore production this year. We've seen a big drop in ore quality. And so, again, Indonesian ore, the grades are dropping because they've been a triple high grading it for this time period. And so, again, that's something that people need to factor into the forecasts going forward. We've seen ore prices in China already climb to international markets. And so, that really does show that Indonesian constraint is there. They've had to import ore from the Philippines through 2024, now to the tune of 3% of global supply. So again, not really sure, these ore constraints are very, very real. In terms of where supply can come from, HPAL outside of Indonesia has been struggling. We've basically known about all of the laterites that are ferronickel capable producing ferronickel since the 1980s. We haven't had a high-grade nickel sulfide discovery since Voisey's Bay in the early 1990s. And so, we think the big, large tonnage ultramafics like we have at Canada Nickel are really the only source of supply going forward. So thanks for the time, and look forward to the questions and discussion.
Thank you very much. Next, I'd like to invite Steve, who runs the only listed US nickel ETF, ticker NIKL. Steve, what have you seen in terms of the companies that you own and the money flows in and out of nickel? Have they been destroyed in the last year as nickel's gone from hot to cold, or what?
Yeah, thanks, Simon. It's great to be here, and excited to be here on this panel. Just to give you a little idea where we come from as it relates to nickel. So we do have one ETF related specifically to nickel. It's the Sprott Nickel Miners ETF, and the goal of that ETF is really to focus on pure play nickel miners. And the way we define pure play is that the fund's going to have a focus on anything that has any company that has at least 50% of its revenue or assets tied to the mining or exploration or production of nickel. We do have a small sleeve in there for 25 to 50%. It makes up about 15% of the portfolio, so relatively small. The reason we have to put that in there is just given our high standards for a pure play strategy. There's not sufficient companies out there to meet that criteria. Another thing that we do within the fund is we avoid mainland China equities, so no China A shares are in the index. And once we do that, we're left with a fund that has about 25 names in it. It is fairly concentrated toward the top. So, Nickel Industries will be our largest holder at around 18% or so. But we do have some caps within the investment universe where, we're going to make sure that nobody gets to be too large within the fund. As far as weighting within the benchmark goes, it's a little bit different than what you would see from a mine production standpoint. So Australia is actually going to make up about 31% of the fund, and then followed by Indonesia at about 30%. And then Canada is around 19%. And we tail off from there with Philippines and France as we move down. So the impetus for bringing this fund to market, I think as the previous two panelists here spoke about the dynamic shaping up is we're traditionally a precious metals and focused shop. And about 3 years ago, we started moving into the energy transition space. And with that, we offered the Sprott Physical Uranium Trust. And from there, we wanted to look at the market and figure out, one, where are those growth commodities that we think, as we move through the energy transition and critical materials life cycle, which are those metals that we think could perform well over the longer term? And then with that, we also looked at the investment landscape. And once we did that, nickel is one of those areas where we thought there's that long-term growth potential, but also we didn't see a product out there that we thought would meet the high standards that we have when we list a product. And about 17 months ago at this point, we launched NIKL, and it took a little bit of time to get going. But earlier this year, we did see, as sentiment turned briefly from about February through June or so, we did see assets start to pile into the fund. Over the last 2 months or so, we've seen some of that come back out, but we have seen the assets kind of reach a kind of a next higher leg there. So trading's actually increased. And one of the good things about the ETF wrapper is, one, it tends to be a little bit more tax efficient in the way that you can manage the fund. But on the other side, you're also getting the benefits of the diversification. So you don't have to pick any one single name and hope that company outperforms the rest. We do have those 25 in there to kind of spread that risk around. The other aspect of it is, given how internationally focused it is, it can be difficult for investors to access those markets individually. So by pulling all those assets into one single wrapper, it allows investors to actually go out, buy one fund, and have exposure across the globe. And with that, it's also taking out some of the issues that you might have as far as trading in different currencies and things like that, if you were to execute individually as well. So from that standpoint, we think that NIKL stands up very well as an investor tool. And kind of on the other side of that, given that it is traded, listed primarily on the NASDAQ here in the United States, traded across exchanges throughout the US, you do have this liquidity that isn't necessarily inherent with all the other securities in the index. So if you were to look at the index and were to trade them in the proportion that they're into the fund, you're going to see an average spread of somewhere around 1.1% or so. But with the ETF wrapper, it provides a more liquid option for investors to access the market. And we see spreads are about 45 basis points lower in the ETF relative to the underlying holdings. But it was great to hear the other panelists here talk about their views here, and it's a sector that we're very excited about. Back to you, Simon.
Thank you, Steve. Look, the last knowledgeable expert on the panel today is Matt Fernley. Matt, thank you for interrupting your holiday in France, and thank you to your wife especially. I've no doubt dinner is waiting, but we thought it would be important to get somebody with your experience to give us your thoughts. Now, you've been buy side and sell side. You currently work for the Volta Energy Transition Fund. Tell us how you think of nickel and the future of supply and demand, and therefore price, please.
Yeah, sure. Thanks, guys. Thanks for the invitation to present. Thanks to the other panelists for really interesting presentations as well. Yeah, so my background, as Simon said, was actually working for him in the past as well, on the sell side. But also I'm managing director of Battery Materials Review, which is a monthly subscription periodical which focuses on the whole of the battery sector and the battery material space. Now, despite what you may have read, the EV event is not over. So you can't pick up an analyst report at the moment without hearing the death of the EV event. It is not over. EV sales growth is still running at 25% year on year. But what we have seen is a number of changes in the makeup of the growth. So EV sales growth in the US and in Europe is pretty weak at the moment, but it is growing very strongly still in China, and it is growing extremely strongly in the rest of the world. And what's very, very important about this Chinese growth is that we're actually seeing a situation now in China where EVs are priced at the same level as ICEs. So we're actually starting to see the EV market mature in China, and we see a huge plethora of products which appeal all the way up the buying spectrum. So if I want to buy a $10,000 vehicle, I can buy a $10,000 EV. If I want to buy a $100,000 vehicle, I can buy a $100,000 EV. And that is very, very important in terms of sort of setting the scene for what we could expect to see in the rest of the market as EVs move more into the mainstream. Now, there is one other factor that's very important in EV land at the moment, and Olivier referred to it earlier, which is the growth of the plug-in hybrid electric vehicle, PHEV, which has grown very, very rapidly in China over the last 12 to 18 months. We're now seeing PHEVs being about 40% of EV sales in China on a monthly basis. And that is very, very relevant because, as he said, PHEVs have smaller batteries than BEVs. So your average plug-in hybrid electric vehicle has a battery size of about 17 kilowatt hours. Your average BEV has a battery size of about 60 kilowatt hours. It's a little bit changed around in China. The plug-in hybrids have larger batteries, around about 25 kilowatt hours. So what we see is, even though we're seeing faster growth in China, we're not seeing as much growth in materials demand out of that EV growth as we are in some of the other markets. So that's something to bear in mind. The other aspect that we've also seen with regards to the nickel market is, if you sat down and asked any of us 4 or 5 years ago, we would have said, yeah, very, very strong demand coming from nickel for EVs. What we've seen over the last 3 or 4 years is the growth in the LFP battery chemistry, which is winning a lot of mass market share of nickel-containing batteries. So there's still very strong demand to come through from EVs for nickel, but it's perhaps not as fast as we would have said it was 3, 4, 5 years ago. And I think that's very, very relevant. We generally see nickel-containing batteries focusing on the premium end of the market, and lithium iron phosphate batteries in the mass market end of the market. But there's still very, very important markets for nickel-containing batteries. And with nickel prices in US dollar terms relatively low at the moment, that's actually a bonus for nickel-containing batteries, because the prices are quite similar in dollars per kilowatt hour to the cheaper LFP batteries. One aspect, I think, which we hear about a lot on the battery side, and perhaps some of my colleagues might want to jump in on this, but is the ESG relevance of the supply chain, and particularly with regards to the very high carbon intensity of the Indonesian nickel production vis-a-vis the relatively lower carbon intensity of nickel production from sulfide. Are we going to see a differentiated pricing structure in nickel over the next 4, 5, 10, 15 years? We're not seeing it at the moment, but will we see it going forward, I think, is a very, very important question. You know, it's sort of on a par with the IRA compliance of nickel supply, but certainly very, very important from the point of view of growth outside Indonesia and outside China in nickel supply. I'll bang it on the head there.
Thank you, Matt. Lots and lots of things to come back upon. So now we're going to start the Q&A amongst the panel members. And so any of the panel members, feel free to put your hand up and ask one of the others, or just interrupt me. I've got one to start, though. A question for any of the panelists. when I was first learning supply and demand of commodities, there was a couple of rules during the super cycle in the early 2000s. The rule of thumb was, if China is long of it, stay out of that commodity because they're wildly deflationary in terms of producing more units of the metal that goes into their supply chains, in this case, EVs. Is that not the case here, given that the Chinese control of the Indonesian nickel units? They put their capital in to facilitate the extraction of Indonesian units of nickel or stainless steel. Anybody help me with that one?
No, I think the two things with China, I think that was definitely the rule of thumb. I think you need to think about where that production sits in the cost curve. So, you know, if it's in the first or second quartile, then you need to be very nervous and definitely stay away. If it ends up as more marginal capacity in the third and fourth quartile, you know, then it's less of an issue. And I would say, you know, nickel pig iron 15 years ago, when they were processing 2% plus ore in China, you know, that's one set of sort of cost structures. You know, today with coke and coal prices going higher, with ore grades in Indonesia. So some of those charts I had in the presentation, you know, 15 years ago, ore grades were over 2%, then they became 2%, then they became 1.8%, then the benchmarks come down to 1.6, and now we're talking at 1.4 to 1.5% ore being processed. And when you have a fixed amount of capacity, as that ore grade drops, your costs incrementally, you know, just continue to climb at that pace. So I would say, you know, they're out in the end, so I'm not so worried, you know, when you've got a big cost difference relative to them. The other piece is, I mean, really me starting talking about blood nickel in terms of the impact that, you know, Indonesia has. It's not just you know, massive carbon footprint, massive local environmental damage, you know, massive disregard for worker safety, you know, and that's not the kind of nickel. If you're buying a car to be clean, green, and help the energy transition, and it's filled with nickel, you know, that comes from, you know, working conditions that would have been 1940s or 1950s, you know, here in the West, not the kind of nickel that you want to populate your car with. And I would say the third piece is, it's really Indonesia that controls the ore supply, right? And so we're now seeing Indonesia flex its muscles a little bit going forward. And so, you know, they control more of the market than OPEC did at its peak. Investing in oil companies in North America in the early 1970s was a pretty good trade for several decades. I think investing in non-Chinese, non-Indonesian sources of nickel supply will be an equally good trade for the next few decades.
Interesting. Thank you, Mark. And Matt, I see you have your hand up as well.
Yeah, maybe just ask a question of my my two colleagues, Mark and Olivier, who are a little bit more steeped in the industry than I am. I'm really interested in the what do you call it? Maybe the dynamism of the nickel cost curve now. In the past, you know, when you're mining sulfides, it's quite a static cost curve. But now with nickel pig iron, RKEF, it's very, very susceptible to energy prices, coal prices, etc. So how sort of elastic do you think the cost curve will be to rising energy prices in an IP takeoff or something like that?
I can talk about that a bit. I think it's likely to be fairly elastic, especially when you consider the amount of nickel pig iron that is being produced. So it's not just that the costs can change based on energy prices. It's also the fact that you're moving a fairly large of what is now a fairly large chunk of total refined production. So and adding to that as well is that a lot of the NPI capacity in Indonesia can switch from NPI to matte if the payables are better there. So that not only can you have a big chunk of refined supply moving about on the cost curve, but some of it can even disappear completely and move to something else and then reappear as a different type of refined product. Because if you're going to convert your NPI to matte, then you can use that to produce, well, anything else you want, really. I mean, typically class 1, but I mean, you can go and process that into something else. So I think it is quite possible that we will see the cost curve and the cost structure beginning to move, or to have the potential to move a lot more.
Yes. So, and building on that flexibility question, which sort of statement that Olivier made, which I, 100% agree with, we've had to get to this point over the last 2 years, to basically get out of this class 1 versus class 2 discussion. The other key piece structurally, so 20 years ago when it was Inco and Falconbridge, we had huge fixed cost base in terms of labor, in terms of the amount of capital that was required to build the mines and then operate the processing facilities that were built. So, those companies were incented to operate as close to full capacity all the time, because that was the only way you could bring your marginal, keep your marginal cost down. NPI is fundamentally different. So you've got a nickel pig iron plant in Indonesia. A lot of them don't necessarily own their own mines. They buy or separately. So when you look at their cost base, they buy power, and they buy coal and reductant. So close to 90% of their costs are variable. And so, that's the great thing here, is that, they should be able to flex capacity because they don't have this massive fixed cost overhead that they're trying to minimize all the time, which again prevents the buildup of big surpluses. That's, one of the big reasons why I was really, these big surpluses we're seeing didn't make any sense, because it doesn't make sense to produce a product that's 90% variable cost to not be able to sell it.
Interesting. Well explained, Mark. I didn't realize that. And related question is, what proportion of the nickel units coming out of Indonesia are nickel pig iron before they become something more like a battery nickel?
Yeah, I mean, mostly I would say at the moment it's mostly NPI, but the Indonesian government has made it quite clear that it is not keen to see the NPI capacity in Indonesia expanding. It is much more interested now in expanding the intermediate side of the equation. So that'll be the MHP, which is predominantly an intermediate product to then go on to nickel sulfate and typically now the battery industry. So I think that that product mix is going to change, and you're going to see the share of intermediates rising in Indonesia. It won't all be processed into sulfate in Indonesia, because the nickel intermediates can be exported from Indonesia, whereas the ore cannot. But I think increasingly you're going to see more and more HPAL plants being commissioned to supply the MHP, which will then go towards the battery industry. I think that's the side of the market that the Indonesian government is more interested in encouraging now.
Yeah, and so just building on that, I think the numbers are, say 5 years ago, might have been 90 to 95% nickel pig iron and stainless steel, and now over the last 12 months, you've seen nickel pig iron really level out. And as Olivier said, it's really MAT and MHP that are driving the bus, and and that'll continue forward. And again, that NPI leveling out is driven by two things. One, they've now banned any new NPI capacity to come online. And then two, again, as these ore grades fall, just as an example, if you go back 5 years ago when someone said, oh, we're going to build 5 lines at a new plant, each one of those lines were said to produce 8,000 tons of nickel. But today the ore grade has fallen from, say, 1.8 to 1.5 to 1.6, that same line can only produce 6,000 to 6,500 tons. So that capacity is effectively slowly being derated over time. So it'll be, again, very interesting to see how that mix moves forward.
Gotcha. And maybe a question for the analysts that have looked at the supply-demand balance of nickel. When does demand catch up with all this extra Indonesian supply? Which, when I look at some of your charts, Olivier, it's sort of roughly 2.5 million tons at the 2020. It's roughly 5 million ton market by 2030. When does demand catch up with supply and therefore get the price of nickel up?
We've got demand catching up with supply pretty soon. I mean, we think probably as early as next year we might start to see the market coming back into balance. It's this year, I think the market is taking already a large step towards balance, but not big enough. And it's not just demand catching up with supply. It is also the fact that we have seen a lot of production cuts being announced this year. They were many of them were in Australia, We've seen Ravensthorpe exit the market. The latest announcement was Nickel West, which will go on temporary care and maintenance at the beginning of Q4. So that one is still in the market. We've seen Glencore shut down its Koniambo smelter in New Caledonia. Again, it's trying to sell its stake. I don't know how well that's going, but these were announcements made early this year and during the course of the year. Next year, you're going to see that those closures will apply to the whole year. So you've also got those production cuts slowing down supply growth as well. So we think next year could be when the market returns towards balance.
Next year, okay.
Yeah.
And if anybody's got a comment, especially people like Mark and Matt who followed this industry for many years, decades even, can you get the nickel price going up if the stainless steel market, the Chinese construction market is subdued as it is now? Or do we really have to wait for Chinese construction demand to come back?
No, I think that's so the big, thing, and Olivier and I have a difference in terms of, stainless demand forecasts. And so, one of the key drivers for it is really not just China. That's been, sort of the last 5 to 10 years, people have said, oh, as China slows down, stainless consumption is going to go down. The reality is stainless steel is a high strength to weight ratio, highly recyclable, good long life cycle cost material. And so because it doesn't corrode. And so it's grown at a really high growth rate for a long period of time relative to carbon steel. And we don't see any of that slowing down. So some of what gets made in China is because the stainless steel is produced in China, it gets bashed into a shape and exported to, say, Thailand or Indonesia, or some other place in the world. So yes, China's slowing down a little bit. It's going to have some impact, but at the end of the day, that sort of 5 to 6% stainless demand growth, we don't see slowing down anytime soon, given the fundamental properties of the material.
Gotcha. Thank you, Mark. And just before we get into the, I'm going to read out some of the audience Q&A here. There's some really good questions there. Can I ask each of the panelists to think about a nickel price forecast for the end of next year, 2025? We'll ask you to go around the panel and ask your forecast at the end of the webinar, which is about 20 minutes away before we get into the audience Q&A. But one question, Matt, for you. You spoke about lithium iron phosphate batteries being important for nickel demand or absence of it. Can you talk about new battery technology and what that means for nickel demand?
Yeah, so really, we think that lithium ion is kind of the mass market technology, certainly for the next 5 to 10 years. I mean, may be wrong on that, but coming around on the fringes, we've got solid state that a lot of people talk about. To be fair, a lot of people have been talking about solid state for the last 6 or 7 years as well, being just around the corner. But I think probably solid state will start to come into commercial production towards the end of this decade, towards the beginning of the next decade. But it's going to be quite an expensive technology, so it's really going to be a focus for premium vehicles. And solid state basically just means that you've got a lithium anode and that you don't have a liquid electrolyte. So it's a lot safer, it's a lot more energy dense. You could very well still use a nickel ternary cathode in solid state batteries. Some people are exploring solid state with LFP, but a lot of people are also exploring solid state with nickel ternary batteries. So probably much of a muchness there. The other big technology on the drawing board is sodium ion batteries. So using sodium instead of lithium as the ion. But we're hearing increasingly now that sodium ion batteries will utilize a transition metal cathode. So again, that could very well be a nickel manganese cathode. So don't expect to see a significant reduction in nickel demand off the back of those new technologies coming through. I would say at this stage, sodium ion is kind of off the drawing board insofar as lithium ion cell prices are so low. There's no need to move into sodium ion at this stage. But solid state is kind of like the holy grail with much higher energy density than lithium ion batteries at the moment, which obviously would would include having a smaller battery in your vehicle or larger range. So solid state is still very much under investigation, being tested, being developed, and but there are still a number of issues with regards to cyclability and other issues there. So we're still thinking solid state towards the end of this decade, beginning of next decade, but don't expect it to take a huge amount of market share probably until the mid part of the 2030s.
Thank you, Matt. So if I can now read out some of the audience Q&As. Here's a question. Anybody of the panelists, feel free to answer. Indonesia is in advanced talks with the USA on a free trade agreement. This could allow Indonesia to export nickel, IRA-compliant nickel direct to North America. Can anybody talk about the implications of that?
I would say, if I can jump in, I would say that it would allow Indonesia as a brushstroke to export nickel to the USA, but just to check out what is the ownership of the assets in Indonesia, because assets with a high degree of Chinese ownership are locked out of the IRA. They're not IRA compliant wherever they're located. So, you know, Indonesian nickel per se would be allowed to go into the USA and be IRA compliant. But if the asset is majority owned by the Chinese, it would not be IRA compliant.
Yeah, just building on that, we got very close last about a year ago. The U.S. government was flirting with it with pressure from the car companies. There was basically a bipartisan letter with about 10 senators from both sides of the House who said, not on in our lifetime for various reasons. And so that has now completely fell away. And as Matt indicated, there's now this foreign entity of concern rules, and that's more driving things. And given, you know, the fact that even if the Chinese don't own the percentage, the fact that it's effectively Chinese built and operated is really going to factor into those discussions. So you're going to, you know, other than Vale, right, which is the ex-Inco operation there, you know, the rest of the assets are effectively Chinese built and operated. And so you'll see some deals. Ford has the deal with a Vale joint venture, but I think outside of that, it'll be pretty difficult for the next few years until you see some fundamental restructuring from Indonesia. And so I don't expect that anytime soon. And if they do clean up their mining methods to comply with Western regulations, that's just going to drive up their costs fairly significantly. So, you know, not afraid of Indonesia at all.
Thank you. A question specifically for you, Mark. When will CNC nickel be in production, and will it be IRA compliant?
Yes, 100% IRA compliant. One of the few new sources of IRA compliant nickel that could come on the market. That's why we're so happy to see Olivier's chart there. And there's a massive gap, you know, in terms of the battery plants being built and the amount of IRA compliant nickel that's available. We're looking to get our permits, financing package by the end of this year, permits by next summer to begin construction and be in operation by the end of 2027.
Thank you, Mark. A question from Mr. Frank Leshawn. Could Indonesia run out of ore they are already importing from the Philippines?
Comment there, and if everyone else wants to jump in, they won't run out of ore. What they're running out of is higher grade ore. So, you know, they ran out of 2% ore, then they've run out of, you know, they don't have as much 1.8% ore as they would like, you know, and they're moving down the grade curve to 1.6, 1.5, 1.4. What they're importing from the Philippines, there's three different things that you're trying to manage with ore. One is the nickel grade, so you know how much nickel ultimately comes out. The iron to nickel ratio, because the iron and nickel both end up in the product. If you have more, the higher iron to nickel content, you end up with less nickel coming out for the same amount of capacity. So they may be buying Philippine ore that's got a better iron to nickel ratio. And the other part is you need there's certain elements that you need to balance for the chemistry to make slag, and these things make lots and lots. 90% of what they produce is slag, and 10% comes out as metal. So 10 to 15%. So that slag chemistry is also very important. So again, we've seen these imports to date. I mean, we may see more. They won't run out, but they're effectively continuing to derate their capacity over time.
Thank you. Mark, a specific one for you. Are you planning to list on the TSX soon?
Oh, versus the TSXV, we
Yes.
continue to look at it. We'll make that decision, when it makes sense for us to move up to the main board. Right now, not seeing a clear benefit for the extra cost at this point in time.
Got it. A question for any of the panelists. I think I know what your answer will be, Mark. How do you make money buying nickel companies producers? Stephen, I don't know if you can comment, given that you own most of the investable ones, but anybody else? Obviously, Canadian Nickel, we are big fans of, Mark. Which are our favorite companies or jurisdictions, or maybe even laterite versus sulfide nickel? Which companies do we buy if we want to make some money because the share price is going up?
Yeah, I could start with that. So I'll say one of the benefits of having a passive-based strategy, right, is we're a little bit, we don't have a stake in any one company and a view on how any one company is going to perform relative to another. And that's part of the diversification that you get in the ETF wrapper. Our view, as we talk to investors, is always to focus on the longer term investment thesis. And for us, and based on what we're hearing in this conversation, really is kind of that in a nutshell, is that over the longer term, we're expecting to see increasing demand for nickel, supply issues potentially along the way that we're expecting to see there. So as it relates to individual companies and what type of nickel they're bringing out of the ground or what individual ore grades are, that's not something that we focus on. But the investors that we hear most from generally understand the story and the importance of nickel as we move through the energy transition. And, now as we start to move into even AI and data centers and starting to see, modular reactors and modular forms of energy generation, if you start to think of, solar farms that are close to where the energy is going to be used, you need to have battery backup. We see significant growth coming from that as well. So that's kind of where we're at. We stay upstream in the supply chain. So we're very, very much agnostic as to what types of battery chemistries might take prevalence over another one. So that's kind of what our view is.
Got it. Are there any hot exploration stories out there at the moment? I recall, as a West Australian, the infamous Poseidon nickel boom, which there was some leaks to local newspapers, and the punters, Australians, the biggest nation of punters in the world, pushed the Poseidon nickel company up 200 times and all the way back to zero again. I recall that Voisey Bay made billionaires out of people like Robert Friedland. Are there any hot exploration stories out there? Maybe Matt, that's one for you.
Sorry, I don't talk about individual stocks, I'm afraid. Sorry.
Okay. Mark, you can talk about your own, I guess, or any other exploration success.
Yeah, no, I would say in terms of the one thing that I would not buy in the nickel industry is grade. There are lots of little nickel deposits that haven't amounted to anything that can generate some very sexy grade intervals, which unfortunately a lot of junior investors focus on, and a lot of those do end up being zero or close to zero. I think just focus on cost structure. At the end of the day, if the deposit can end up in the first quartile, second quartile of the cost curve, you don't have to worry about battery chemistries and Indonesia and you're always going to be in a safe place relative to the cost curve. So it's not necessarily about grade, it's about infrastructure. It's about, are you in a place where you can actually develop the asset? And again, I think the real, there's been a huge amount of noise and time on class 1 versus class 2. The real differentiator is going to be clean, green, IRA compliant nickel versus the rest of the world. And that we already have premiums in the United States for things like carbon steel, for stainless steel, for a wide range of metal products. Those premiums are only going to increase. Biden put a new round of tariffs in place a few months ago. Trump's only complaint was that they weren't high enough. And so, if you can pick up assets that are inside the fortress that they're building higher and higher walls around, that additional value is going to trickle down to shareholders in the long run.
Yeah, just one note on that point. So we spend a lot of time talking to investors in Europe, and that's something that they're very much focused on, is the greenhouse gas emissions of the underlying companies. So they're starting to look through to the portfolio and very much demanding some sort of ESG screen, and it typically tends to be around looking at the whole life cycle of once the ore comes out of the ground to once it's produced and arrives at its destination, making sure that anything that they're looking to achieve from buying an EV or solar panels or anything is not being offset by what's happening at the mine site.
Look, the final question that I have from the audience, from the esteemed Tony Williams, is around the ESG, the big ESG concerns of Indonesian nickel operations, which I think we've covered. But he also is asking you, gentlemen, what is your nickel price forecast? So perhaps I could suggest that we close the webinar. Thank all of you for attending. For Peter Gadsden and miningnetwork.co.uk as my co-host from Arlington. But thank you, Olivier, Matt, Mark, and Stephen, and ask you to give us a price forecast for nickel at the end of next year, 2025.
Well, I guess I can start on that one. Q4 2025, we've got an average price of $20,000 a ton, around there, just under $20,000 a ton.
And Olivier, just for reference, for those that may not know, the current nickel price is?
Around 16.
Right, so
bumping along there.
20% higher, give or take. Good. Matt, what are you thinking, buddy? Are you able to give us a price forecast, or is that top secret?
I don't actually forecast the price of nickel, but I'll go for a stab in the dark and go for 22,000.
Or getting higher, even better. Stephen, you have to be bullish, don't you?
Yes, longer term we are. We don't provide a nickel price forecast, but longer term we see the investment merit as contributing to longer prices over the longer term, or higher prices over the longer term. That is. So
higher for longer.
Long term, yes.
That's good.
Good, Mark.
Yeah, and I'm on the record through the weekly, bi-weekly podcasts I do that nickel prices will get up to $20,000 a ton by the end of this year. From back in January, we touched it briefly already, a little prematurely, but I think by the end of 2025, we'll be in the 22,000 plus higher range at that point in time.
Good. Well, I'm hearing 20 to 22,000 or higher through the end of next year. Gentlemen, thank you so much for all of your educational commentary on nickel. Really interesting. Thanks for joining us on a August Friday afternoon. Thank you and good day.